Good afternoon, and thanks for joining us on today's webinar, State and Local Income Tax Update 2023. I'm Lindsey Haney, Senior Manager and SALT Leader with the firm, that's State and Local Tax. And for those of you that don't know, McKonly Asbury is an accounting and business advisory services firm with offices in Camp Hill, Lancaster, and Bloomsburg, Pennsylvania. We provide a range of services to organizations across a variety of industries, as you can see on the screen, and we encourage you to visit our website to learn more. If you've joined us on past webinars, welcome back. If you haven't, our monthly webinars feature various business topics to keep you updated on what's going on around us. Be sure to check out our website to catch past presentations as well as current information through our blog. You should see on your screen a polling question for today's webinar. If you have any questions for us during today's presentation, please submit them through the built-in questions function in the webinar control panel, and we will do our best to answer them during or after the webinar. For those of you that are looking to obtain CPE credit for today's webinar, please keep in mind that there will be 4 polling questions throughout today's presentation, and you'll need to answer all 4 of those questions to get your certificate via email a few weeks after the webinar. So I'll pause here. The first polling question is on your screen, so please take a moment to answer that on whether you would like to receive CPE for attending. All right, about 10 more seconds. Make sure you get that question in. Okay, so it looks like a lot of you are in it for the CPE, and that's great. For those of you that are not, kudos to you for joining the webinar when you don't have a requirement. All right, so I'm going to go over the agenda first. So we're going to start with the state impact of federal changes to the code, and then go into a little bit of nexus overview. I know this webinar is called income tax, but I'm going to have a touch of sales tax in there as well, and just overall nexus, because we'd like to take an approach at McKonly and Asbury of the whole business, not just looking at one aspect. So we'll go into the nexus overview, and then I'll touch on some trends in state taxation and recent updates. We will continue on then to some pass-through entity taxes and wrap it up with the PA budget and state comparison. I think it says compensation, but comparison and how PA compares to other states. Okay, so before we can really get into the states, I think it makes things a little bit easier, I think, for the rest of our time together if I touch on the relationship between federal and state taxes. So for this section, we'll be mainly focused on income taxes since obviously there's no federal sales tax to compare to. So the way that states handle federal changes depends on what their overall conformity is to the federal code. So you'll note there, we have a chart of the different types of conformity, but it's either fixed, rolling, or select. So for example, rolling conformity means that as soon as the federal code changes, that particular state's rules automatically change to follow the federal rule. So it's on a rolling basis. So rolling conformity doesn't necessarily mean that a state always follows federal rules, because states can still choose to decouple or not follow the federal rules. But it generally reduces compliance burdens on taxpayers, because the assumption is, without further guidance, is that everything is the same for state taxes as it is for federal tax. Keep in mind, conformity can be different for different types of taxes, such as corporate versus individual tax. You'll notice on the chart there that Pennsylvania, as well as a few other states, have sort of the stripes on them because they have different, they have rolling conformity for corporations and not for individual tax. So just in case you can't see, if it's a little small, the blue states there are states that have rolling conformity, meaning they automatically conform to federal, and the yellow states have fixed conformity. Fixed conformity means that the state follows the federal code as of a specified date. So if the federal code is updated, the state actually needs to change their fixed conformity date with legislation before the state would follow any of those updated rules. So they still follow federal, but they have to take a step to update in order to do that. Again, states can choose to decouple from anything they want, but this method allows the states to have that choice to update the conformity rather than automatically updating and having to take steps to opt out of the code portions they don't like. And then finally, you'll notice the last one was select. There are a few states that don't have either rolling or fixed conformity. These are what I'd call the rebel states that just want to do what they want. So they want to choose the code sections that they'd like to follow. And you don't see too many of those. I guess that would be the gray on this chart. One recent update I wanted to mention on that is Virginia actually recently moved from fixed to rolling conformity starting in 2023. So this was passed in Virginia's General Assembly unanimously on April 12th, 2023, and signed by the governor. There's some provisions where they will not have rolling conformity if there's too much of a revenue impact for any one thing. But that's kind of a big change because you don't see states change their type of conformity very often. So I was surprised to see that. All right, so with conformity in mind, let's take a look at the recent federal tax changes we've had and how states are handling those. I think I went a little too far there. Not doing the polling question quite yet, but keep paying attention because that'll be coming up. So the recent federal tax changes we've had. First, I wanted to talk about that 5-year amortization of R&E expenses. That's research and experimental expenditures. You might hear that a lot as R&D instead of R&E, but basically the same thing. With the passing of the Tax Cuts and Jobs Act in 2017, there was a provision for tax years starting in 2022, research and experimental expenditures, which previously were allowed to be immediately deducted, would now have to be capitalized and amortized over 5 years or 15 years for R&E for foreign expenditures. You might have heard about this. It's a pretty hot topic right now because there's a lot of issues with it, a lot of things that are kind of undefined and make it not easy to follow. As you can imagine, it's not favorable to taxpayers along with those complications. So there's really been kind of an uproar about this, but we won't get into that because I'm going to focus on those state and local taxes. But feel free to reach out. You know, I'm happy to talk about that issue as well with anybody, just not in our webinar today. What I do want to touch on is the state treatment of this issue. So most states at this point do conform to this provision, since even the fixed conformity states have updated their data enough since this was with the Tax Cuts and Jobs Act in 2017. Most states are updated to that point at least. So most of them would be effective without other legislation. So most states would have to specifically decouple from this provision in order to not follow it and to not capitalize those costs like it does for federal. One example of one that doesn't is California, which still has a fixed conformity date of January 1, 2015. So going back to the conformity, that's why I wanted to touch on that first, because if you have a date of 2015 and the Tax Cuts and Jobs Act wasn't in place until 2017, the state would not naturally follow these rules. A few other states to mention. First of all, Georgia, they are a fixed conformity state, and they recently updated their conformity date to January 1, 2023. So they would naturally follow it, but with that update, they specifically decoupled from Section 174 and will allow a full deduction for R&E expenditures for 2022. So they've already come out and said, even though you have to capitalize for federal, or I should say might, depending on whatever happens here, you could still deduct it for state in Georgia. A few other states, Indiana also specifically decoupled from 174 starting with 2022. Mississippi specifically decoupled and allows the full deduction, but theirs starts in 2023. And Tennessee is one that decoupled as well. So we do see states that are, you know, they're saying that we're allowed to deduct these R&E expenses even if they have to be capitalized for federal. I think, again, it's more of a federal issue. I wait and see kind of what happens here, since there are a lot of issues with that rule in general. But just something to keep in mind, if that rule does stay in place by the tax deadline, then obviously it will need to be followed and you'll need to know those state rules. So the next one there is bonus depreciation. Many states, including Pennsylvania, specifically decouple from bonus depreciation and don't allow bonus depreciation. So, but for states that do allow it, which there are several, it may be an issue to watch whether these states will follow the reduction or continue to allow 100% bonus depreciation. Because for federal, if you recall, the Tax Cuts and Jobs Act allowed 100% bonus for the last, say, 2 through, I don't even know how many years it's been now, but for 2023, it starts the reduction where bonus depreciation will be phased out. So for 2023, it's 80%, goes down to 60. So we will have to watch the states for that. I would imagine most will probably, if they do allow bonus, they'll probably continue to follow federal, but I can't speak too soon because Oklahoma, for example, has permanently provided the option to immediately expense those business assets, which is a pretty bold move when you consider permanent in anything taxes. It's especially when it comes to something that's favorable for taxpayers. So Oklahoma said they enacted it last year, and they were the first state to authorize full permanent expensing for business assets. So that's a pretty interesting one, maybe something to keep an eye on going forward. I wanted to also then mention Section 179 expensing. Now, there hasn't necessarily been many federal changes recently with this. It was one where under the Tax Cuts and Jobs Act, the limit for 179 increased from $500,000 to $1 million, which was a pretty big change for a lot of taxpayers who were limited before. And many states do conform to 179, whereas they don't to bonus. But it's not a federal update because there's nothing changing right now. I wanted to mention it though, because there has been a change to Pennsylvania for Section 179. Pennsylvania typically conformed to Section 179 for corporate income tax, but they had a limit of $25,000 for personal income tax. So you could only take $25,000 of 179 for Pennsylvania purposes on an individual income tax return. That's pretty low. I mean, $25,000 for most businesses is pretty easy to get to. So the governor's budget last year changed this to match the federal limit. So Pennsylvania businesses can now deduct more under Section 179. So that was actually a very big change, something that was very limited before. And I should mention, not only was it limited to $25,000, but if you had over a certain amount in additions for that year that were eligible for it, it could be completely phased out as well. So Pennsylvania changed that, and now they follow federal, which in general just makes things a lot easier for everybody and more favorable to the taxpayer. So it might also be more applicable with bonus depreciation starting to phase out, because it's been a little weird the last couple of years, because we saw bonus and 179 a lot of time having kind of the same impact, where you could just deduct, essentially expense your additions with both of them, because bonus was at 100%, Section 179 allows a full deduction. And really, we saw a lot of clients where the $25,000 limit for Pennsylvania actually came into play, where it made more sense to choose 179 because Pennsylvania allowed that amount. Like if you didn't have a lot of assets added, then you would be able to deduct them for Pennsylvania, whereas you can't deduct the bonus. Pennsylvania does not allow bonus. So that's kind of some of the analysis we do as tax advisors, looking at these rules and figuring out what is more beneficial for you with the ever-changing rules and how federal and state rules interact. So with bonus depreciation reducing down to 80%, that's something where we'll now have to look at, okay, does 179 make more sense now? It might be that bonus made more sense in the past. And of course, there's different rules, like you can't take 179 if you're in a loss, but that's sort of the analysis that we do. All right, so the other thing I just wanted to touch on, and again, there haven't been a ton of federal changes with this one recently, but the interest limitation, Section 173J. So this is where, for federal purposes, businesses that aren't exempt might have their interest expense limited based on various factors like their income. And they might not be able to deduct it in the current year, whereas they might have to have a carry forward for federal purposes. So I would have talked about this a lot more in past years, just because you do have to look at the state effectiveness as well, because in the past states might not follow that federal limitation. That would go back to their conformity, or they might have put out guidance on whether or not they follow the 163J limitation. But because in the past there have been differences, you might have a different carry forward for state than you do for federal. That's always a possibility. I also wanted to mention it because for 2022, there was a change in calculation where you were no longer allowed to add back the depreciation and amortization deductions in doing the calculation. So it became less taxpayer friendly in 2022. Now, I don't see a lot of states decoupling from that specifically, but again, I just wanted to mention it because it's something to keep in mind, that you might have a different carry forward for the interest limitation. All right, so with that, we will go to our next polling question. So everybody pay attention in case you're looking for the CPE. Our next polling question is, how would a state with rolling conformity typically treat R&E expenditures for 2022 as the law currently stands? So they will not all be this hard. I'm giving you a tough question for this one. I'm gonna see if you're listening and see if you can get it. But this is your first polling question. Answer it. Whether or not it's right. It's okay if you get it wrong, we'll still give you CPE. Okay, are we good here, Audrey? I think, all right, we're ready to go. So hopefully you got that polling question. It looks like we're a little bit split on this, but everybody did really well here, because I would argue that the answer is both B and C, but I could definitely understand either B or C, because in general, if you have rolling conformity, you're going to follow federal. That's kind of how, like I've explained, the rolling conformity works. So that's where the B comes from. But you can never rule out that depends on the state answer. So you always, because even if a state had rolling conformity, there's the chance that they might actually not follow 174 specifically. They might decouple from it. So that was kind of a tricky question. I'm proud of everyone. That was a very good one, and I think you did well. All right, what do we have next? State nexus. All right, this is probably my favorite topic. This was something that was just becoming really, really more and more relevant as I've been at McKonly and Asbury and throughout my career, because I don't want to say it's only gotten more complicated, but it has. It's gotten more interesting, we'll put it that way. So with state nexus, part of what makes it so complicated and why so many tax professionals stay away from this field, state and local tax, is that there's a lot of issues that we have to figure out how to apply over different tax types too. A lot of tax professionals like to just stay in their income tax role, because, I mean, frankly, that's complicated enough without getting into state and local tax. But with conformity, we were generally just talking about income tax, right? Because you have federal income tax, and the conformity is how the state income tax relates to that. It's still, don't get me wrong, can be extremely complicated just looking at conformity, but at the end of the day, at least we're only talking about income tax. Whereas when you get to nexus, and this is where we like to help our clients, because it gets really hard for business owners to understand this stuff, and nobody can know everything. A lot of my job is research to figure the answer out for you. But it's something that I really like helping clients with, because it's very hard to know what you don't know. And I think that's what gets complicated about state nexus. And that's what business owners worry about, is what am I not doing that I'm supposed to be doing? So that's where we try to come in and help. So let me start out by explaining what nexus is in case you're not familiar. Nexus is the minimum contact necessary for a state to impose tax on a taxpayer. The minimum contact necessary for a state to impose tax on a taxpayer. In other words, what level or type of activity do I need to have in a state in order for them to be allowed to tax me, right? So that's what nexus is generally. But it's important to remember that nexus can be different for different types of tax and can be different than the requirement for a state to register to do business in a state. Often these requirements refer to whether or not a business is, quote, doing business in the state. Like you'll go look at the rules of whether you need to register, and it'll say you need to register if you're doing business in the state. Well, what does that mean? I mean, what is doing business in a state? And the fun part is states have all different definitions of this. So it's extremely hard to figure out for yourself. And then the fact that it compiles with all these different types of taxes that you then have to figure out. I know I'm biased as a tax professional, but I would definitely say go to a tax professional if you're not sure. All right, so the reason nexus has come more to the forefront in recent years is because of the Wayfair Supreme Court case in 2018. And I've been lucky enough to follow this case since it was in the works and kind of see it through the whole process. But in the Wayfair case, I'll just go over kind of the background of that a little bit so we can make sure we all understand what we're talking about when we get into nexus and why this is so relevant. In the Wayfair case, basically, back up before all that, South Dakota, along with several other states, passed legislation that required remote companies, meaning companies not in that state, to collect sales tax from their customers for that state. So remote companies are companies that are they might be selling into the state through a common carrier. Let's say somebody from South Dakota gets online, orders something online, it gets shipped to them via common carrier. That's the amount of contact they have. So that company doesn't physically enter that state. They don't have employees in that state. They're really just there remotely. So you had people remotely, and then South Dakota put a law into place saying if you're making at least $100,000 of sales into our state, then you need to collect and remit sales tax. You have that requirement. Prior to this, there were previous cases that basically said you can't do that. You can't impose tax on a company if they're not physically in the state. If they're just shipping things and that's all they're doing, it's not allowed. But South Dakota, among other states, put this law into place anyway, and with the hopes that it would actually go up to the Supreme Court. And that's exactly what happened. Whether or not it was legal or whether it was fair, if you want to put it that way, for a state to tax out-of-state companies that are only shipping into their state and don't have other activity. So, trying to wrap up this long story a little bit shorter. Basically, the Supreme Court case went through, and there was some controversy on the decision, but they allowed this law. So it really opened the floodgates that basically said, for sales tax purposes, you can put in a rule that says if you have a certain amount of sales, then you have to collect and remit tax. So that's a big requirement. And it's been a huge deal. So immediately after the Supreme Court case passed, you had nearly every state putting these rules into place. And it was kind of wild for a while because it was just constantly, this state did it, this state, you're seeing it a lot. The good news is a lot of states were pretty consistent with the amounts and following something that was very similar to South Dakota's rule. So we are at the point now where a large majority of states do use that $100,000 threshold, where they're saying if you have $100,000 of sales into our state, where you're shipping things into our state, or just sales in the state in general, then you have that requirement to file, which makes it a little bit easier when you're looking at analysis. And we'll talk about that a little bit later, but that's kind of the general number I use. Now, there are states that still have higher thresholds than that. Every state with a sales tax, though, does have an economic nexus threshold. So it certainly has spread. And now I think the last one went into effect in 2023. January 1, 2023 was the very last holdout, and now all states with a sales tax do have an economic nexus requirement. So that was a very long explanation. I hope you're still with me. But long story short, Wayfair changed the rules. They changed the game because now you didn't have to be physically present in a state to be required to collect and remit sales tax, which doesn't seem that bad if it weren't for the fact that every state sales tax is different. And there's so many things that make it so complicated. It definitely has gotten worse in terms of complication. And, you know, things were complicated before. I guess I shouldn't say that. But now, not only are things complicated, but now you're making a lot more businesses remit tax in a lot more states. So that's kind of why Nexus has become a much bigger issue in current years, just because of Wayfair. And we'll talk a little bit more about it. I want to keep moving. I don't want to get too stuck on this slide, but that's the overview of why Nexus is such a big hot topic right now. All right, so this chart is what I wanted to touch on now that I've kind of given that overall Wayfair overview, because this is a nice chart. The first of many charts I'll show you, because I think these types of charts are a really good interpretation and make it really easy to see what different states are doing. So in case you can't see it, it's pretty small. The blue states use a dollar amount based on retail or taxable sales. So one of the complications of economic nexus is, okay, you have $100,000 of sales into the state, but some states say, well, you have to have 100,000 of taxable sales. So the rules vary. A state might tell you just overall sales, even like that might include exempt services or like sales of things that are exempt. Some say only taxable sales. So that's kind of the first thing you have to look at once you figure out the amount of sales. So the blue states use a dollar amount based on retail or taxable sales, whereas the green states use a dollar amount based on gross sales, so total sales. So that is kind of another complication where we have to figure out when you meet this threshold if you do. The stripes on the map represent a transactional threshold. Now this was something I didn't quite mention yet. Part of South Dakota's rule was if you had either $100,000 of sales into the state or 200 transactions into the state. Now, as you can imagine, it probably would not take much for a company selling something small to have 200 sales into the state. So that's definitely could be a much lower threshold. And what we're seeing is a lot of states that might have put that transactional threshold in initially are kind of backtracking because I think they realize it's not really beneficial for anybody to make a foreign state company collect and remit sales tax for $200 because they had $201 sales into the state. It's really not worth the compliance for the taxpayer or the state to do that. So I think a lot of states are recognizing that. You can see there's still a lot though that do have a transactional threshold. And you know, I'm not sure, to be honest, if this chart is saying if it's an and or an or, because I know when they came out, some of them were an or, meaning, again, the 200 transactions would make you file. Some initially they did it as an and, so you had to have both 100,000 and 200 transactions, which that was a little bit nicer too, because if you had one very large sale into a state, then you wouldn't necessarily be required to file because it didn't hit that and 200 transaction threshold. But like anything with state and local tax, this is all very dependent on the state. So, you know, I try to give a starting point with the $100,000. I think that's the easiest place to start to look at, to start to review your nexus. But it can really get into the nitty gritty here. So that's where I'm here to help. Okay, we can't talk too much about Nexus without talking about Public Law 86272. You may have heard this term, you may not have, but I will explain it. So Public Law 86272 is, the first thing to mention is it is related to income tax. Public Law 86272 does not apply to sales tax. So this is not a sales tax concept, which actually does make things very tricky. Public Law 86272 basically says, it's a federal code that says if your only contact with a state is soliciting sales and potentially shipping sales into the state, but that's all you're doing. You're not physically there. You're not going into the state. You're not doing a variety of other activities. You don't have an employee doing other functions other than sales in the state. Then a state cannot impose income tax on you. So it's sort of a limitation barring states from just what they did with Wayfair, but with income tax, it's barring them from potentially collecting income tax from a company that's out of state that only has very minimum contact with them. So it's really, like I said, it doesn't apply to sales tax, but it's really relevant in terms of when you're doing this review, let's be honest, as a business, income tax, sales tax, you have to look at it all. So you're not just gonna look at sales tax and stop there. If you have economic nexus in that state, you're going to need to look at income tax as well, because the way that most states interpret PL 86272 is extremely limited, where if you're doing anything except just that sales activity, just that salesperson traveling in the state, but if they're doing anything other than sales functions, it's pretty easy to exceed Public Law 86272. Now, it still provides protection. If that really is the only thing you're doing, it's certainly still possible that you might not need to file. The other thing to keep in mind is there are states that have minimum taxes that still try to require a filing to pay the minimum tax, even if you are protected under Public Law 86272. Because a minimum tax isn't an income tax necessarily. So it gets really complicated. The other thing I mentioned there is gross receipts and franchise tax, because again, Public Law 86272 only applies to income taxes. So Texas has a franchise tax. PL 86272 doesn't apply. Ohio has a commercial activity tax. Like different taxes that are not based on income does not necessarily apply. So just kind of another wedge in there, making things a little bit more complicated, because do you have to file income tax? Do you not? We try to look at all the different possibilities there, and it's possible to have to file sales tax and to not have to file income tax. And at the end of the day, it all comes down to a business decision of, does it make sense? Because if you believe you are covered by Public Law 86272, sometimes it's a question of, do we need to file? Like, what would our tax liability actually be if we're going to file in that state? Because of course it does happen where maybe you do have nexus in the state for income tax where it's not protected, but you really don't have sales in the state, and the state, if the state uses a sales factor for their apportionment and you wouldn't really have any income apportioned to the state whatsoever, is it really worth filing? So, we like to walk our clients through that and just try to figure out, what is the best path for you. And as I noted there, many states and even localities use that economic nexus for income tax. So yes, Public Law 86272 can protect income tax. Are states going to try to tax you anyway? Absolutely. So again, it's looking at all the different factors and what your specific activity is within a state to figure out whether or not you have that requirement to file or are protected or otherwise don't need to. Another thing I just wanted to touch on quickly is working from home. So this is another thing where, especially after COVID, we see a lot more people working from home and having remote jobs. And there was a period where it was very, very confusing because there were a lot of COVID exemptions where states said, if you're working from home because of COVID, we won't necessarily impose all these requirements on you. But those are all over now. I mean, there's no, COVID's over, right? But now what you really need to look at is, if you are considering having a remote employee, you really need to look at not only the payroll tax, because that's the first thing that people often think of is, well, we just need to get them registered for payroll. Well, having an employee there means you have a physical presence in that state. So there is quite a chance that you will have sales tax nexus and now need to collect and remit sales tax where maybe you didn't before. And income tax as well, because you have that physical presence in the state. Now, again, Public Law 86272 could apply because you could have a salesperson in the state, but if you have somebody that's not doing sales functions in that state, then it probably doesn't. So the other thing you need to look at as well is the state's apportionment formula. Are they a state that uses payroll in their apportionment formula? If they're not, let's say it's sales only and you don't actually have any sales into the state, you might not owe any income tax, you might not need to file. So just something to think about. I like to remind everyone, just because it's a lot more common to have employees working from home in different states, and I know it's not something we think of every day as far as the tax consequences of that. All right, let's see. And we did get a question come through the poll. So for PA contractors, the question is, I do bookkeeping for a PA organization as a contractor who works from Colorado. So this work from home situation. The question is, do I need to take out withholding from my pay? And I'm afraid I'm going to have to give you the very typical answer for this, is that it is going to depend on PA and Colorado rules. So you'll have to look at Colorado payroll rules to see what they require when it comes to an employee working from home. If that is somebody that wants to kind of look at that more specifically, just we'll have my email at the end of the webinar, and I'm happy to answer any questions. Feel free to reach out directly. All right, so we can't talk about nexus without talking about voluntary disclosure agreements. So voluntary disclosure agreements are basically an agreement with the state where you maybe after this webinar, you review your nexus and you look at the different states that you have activity in, and you realize, crap, I should have been filing in this state. And what do I do now? What I can tell you generally is don't just automatically register, don't panic register, okay? Don't panic, but what we'll do is we can go through a process of figuring out what you should have been doing. If there's something that you should have been doing that you weren't, it happens all the time, no need to panic. But we'll look at that activity in that state and kind of help you figure out, okay, what were the potential liabilities? What should we have been doing? And then a lot of states have voluntary disclosure agreements. And these are agreements where we can voluntarily go to the state, and this has to be before they contact you, because if they contact you, it's a little too late. They've cat's out of the bag. But we reach out to the state, and basically I would reach out on your behalf and say, look, I have a client that realized they have nexus. They had it the past couple of years and didn't realize it was a mistake, and they are looking to become compliant. So you go with that information, and then basically you're able to get registered and become compliant while getting rid of those penalties and limiting the period that you have to look back. So you could have been in a state for the past 10 years and not realize you were supposed to be filing. That could be a pretty big liability. But with a voluntary disclosure, then you're able to limit that. Generally, it's 3 or 4 years that you can limit the look back period. So you're able to limit the liability in general, cut it off, because if you didn't file something, there is no statute of limitations on something you never filed. So that if the state came after you, they could go back several years. Whereas this limits it, and they also take off penalties generally. So it's a really good option if you go in and realize that you should have been filing in a state. I think we'll see more of these just because Wayfair has been in place long enough now that the states that enacted economic nexus, it is now in effect and has been in effect. So if you missed the boat on that, this gives us a chance to catch up. So if you come to McKonly and Asbury and work with me on something like this, we'll have an initial call. I will try to get to know your company because it's really helpful for me to understand what your company does so I can figure out whether you have taxable sales and whether what you're doing is taxable in that state. And so we'll get to know each other a little bit, and then I'll kind of walk you through that process. I'll gather a little bit of information, like what your sales were these last couple of years, what information you have on it, what types of sales, and I will basically go through and make recommendations from there. So we'll figure out, does a VDA make sense? What does our liability look like? And kind of really go step by step, looking at both sales tax and income tax. All right, now we go up on polling question number 3. Everybody, there is a polling question, so make sure you get this answered. At what stage are you or your company in the process of reviewing state nexus? So have you done a full analysis and are compliant in various states? Are you in the process of reviewing possible nexus? Maybe you've started to look into it but aren't really sure what to do. Or maybe it's the first you're hearing of nexus. No matter what your answer, please make sure to get your CPE credit. Okay, about 10 more seconds. Make sure you answer the poll. Okay, looks like we've got a lot of different answers, but I would say the majority are at least in the process. We've got 71% at least in the process or done a full analysis. So that is great. I'm not surprised. Over the last couple of years, this really has been more of a hot topic. But you know, if you are in that category of aren't really sure, or this is the first you're hearing of it, don't worry about it. I mean, reach out and we can figure it out from there. I like to say, you know, taxes aren't life or death. There is no reason to panic, and you know, nobody's going to die from taxes, hopefully. So, you know, we will get through it. So feel free to reach out if you do have any questions. All right, next we will roll right next into our next category, trends in state taxation. All right, as I was finding and gathering information for this webinar, one thing I found was COST, the Center of State Taxation, had a sales tax scorecard. They actually went through and ranked all the different states and gave them a grade based on their sales tax. And it was some really interesting information. I do apologize. There are a lot of charts like this that we're about to go through. I hope you like them as much as I do, but I did go a little nuts on the charts because I think they're really helpful. So I apologize for that in advance. This one, as you can see, what really cracks me up, if you notice what color the A grade is, it's green. Do you see any green states? So clearly there's some work to be done on the sales tax scorecard and the overall scores, because there are no states with an A grade. There are quite a few with B, so that's not too bad. Pennsylvania, you can see, has a C, so we're kind of in the middle of the pack, which that does not surprise me too much. I honestly might expect it to be a little worse because Pennsylvania is a bit complicated, but we do have some things going for us, so not too bad. All right, so on the screen here, I'm not going to go through each one of these specifically, but I kind of looked at a few recent updates, and one of the things was data and digital with sales tax over the last couple of years. This has just been evolving in a lot of different states. States have kind of been reaching out more and more on the different types of digital things that they try to tax. So just something to keep in mind, especially because a lot of what companies sell now is digital. So, you know, even if you, no matter what type of company you have, like sometimes if you might have some kind of product within your product line where it is a digital product, this might be something relevant. The other thing is if you do any types of computer services, that's something more and more that we see is, you know, where services aren't traditionally subject to sales tax, they are really starting to a lot. So just something to keep in mind. The other one to mention there is Maryland. A little while ago, they put in place a digital advertising gross revenue tax. So it's like a tax on digital advertising. Now there's, I think, yeah, you can see there, it says taxpayers with over 100 million in gross revenue. So it's really just bigger taxpayers, but it's more the concept of it. The idea is new, and there's a lot of resistance to it. As you can see, there is litigation on it. So just something to kind of keep aware of. It's a tax on digital advertising, which is not really heard of until this. But a lot of digital products, a lot of like data access services, that kind of thing, software as a service is getting taxed more nowadays than ever. Here's another one of my charts. So I have a couple of these as it relates to software and digital things. This one I thought was really interesting because it goes through and does colors based on how many different types of software or digital products are taxable in the state. So in Iowa, you can see there are no select products that are taxable, so they don't really tax software or digital products. The green has one of the different items, and the three items are software, data processing or info services, and software as a service that they looked at in this particular chart. But yellow, 2 of those things are taxable, and red, all 3 of them are taxable. So as you can see in Pennsylvania and surrounding, it's pretty common to have a lot of different software and digital items to be taxable. Also with these charts, I just kind of like to emphasize how different, because I think it's really easy when you're a company operating in Pennsylvania to assume that most other states have very similar rules, and they really do not. Unfortunately, it really varies. This one, though, at least the states around us are not too different. Not favorable, but not too different. And then this one is whether or not the state taxes software as a service. The green states have no tax imposed on it. The blue states do have tax imposed. Yellow is also tax imposed, but there's not really very clear authority on it. So, you might be able to get away with not imposing tax. I'm sure it's just very, very gray area stuff. But as you can see, I mean, that's how sales tax goes. That's why we have to look at each state specifically and look at your specific situation. And then finally, I put one in here. This is for multiple points of use. I won't touch on it too much. Basically, with software, if a company sells software and the purchaser has basically logins where they have employees using it from different states, if it's based on end user, multiple points of use allows you to sort of apportion that based on where the end users are. So Pennsylvania is a state that allows MPU, and basically, if you sell software in Pennsylvania, but then your customer is going to have like half of their users are in North Carolina, you're allowed to tax only 50%. That's kind of the MPU rule. So depends on what it is. I mean, I don't see this that much as I would expect, honestly, but I think it really depends. It's hard sometimes to know where the customer is using it. So that can be a big issue, I think, with actually using MPU. All right, and then I put these in here just because I found them interesting. They don't really go with a topic I have specifically, but with manufacturing exemptions, we have them in Pennsylvania. There's exemptions both for like supplies used in manufacturing as well as manufacturing equipment purchased. This was one as well where I just wanted to point out that not all states are the same. So you can see Pennsylvania is kind of by itself there in having a broad exemption, whereas a lot of states around us have a limited exemption. So if you have manufacturing purchases, if you're a manufacturing company, just something to keep in mind, let's say you were to expand to another state, you are going to be subject to different rules. All right, and then this is basically the same thing, but with the equipment. The other one was the supplies. So I'm going to skip over it quickly because we still have a lot to get through, but feel free to ask me any questions, and I believe you all have access to the slides. So as far as state tax updates, one thing I wanted to mention, Oklahoma recently repealed their corporate franchise or capital stock tax effective July 1. That is very exciting for those of us that don't like filing Oklahoma capital stock tax returns, but also I would imagine people that are subject to the Oklahoma capital stock tax. So that's kind of the continuation of a trend. Pennsylvania actually had a franchise tax several years ago. I think it was repealed back 2015, 2016. But generally we see states go away from that, from capital stock tax, because it's a tax on like the value of the company, and it tends to kind of end up with unfair consequences. So that's why we see a lot of those going away. Taxes on newly legalized sales of cannabis products in Maryland and Minnesota take effect July 1. So that's kind of our recent update. Of course, with the cannabis industry, I would just expect to see more and more of that, as evolving rules change and cannabis is allowed recreationally or medically, we'll see a lot more of, the states are going to try to tax whatever they can. And then in general, Income tax and sales tax rate reductions, that's kind of the direction we see a lot of states going. I have a feeling that has to do with the fact that we do have economic nexus. So, you know, states had all that revenue come in from out of state, so they're able to start lowering those rates a little bit and give a little bit of a break to taxpayers. And then finally, I mentioned this before, but that 200 transaction threshold or whatever it may be, we're seeing a lot of removal of that because states are kind of going to more just the dollar amount, not the transaction threshold for economic nexus. Okay, pass-through entity taxes. So I want to just go over this quickly. It's another one of those areas that it can get very, very complicated very quickly. But just to give you an overview, I like to give enough information that you might know what questions you want to ask. So this might kind of give you an idea of what PTE taxes are and whether they could be relevant to you. So going back to the Tax Cuts and Jobs Act, because we're still looking at those rules, it limited state and local taxes individuals could deduct up to $10,000. So previously on Schedule A, you were able to deduct state and local taxes. The TCJA limited that, they capped it. They said you can't deduct more than $10,000 of state and local taxes. A lot of states had issue with this because states with higher tax rates, this was a big benefit for their residents, and now it was gone. So there were a lot of looks at like how they could work around it. And then in 2020, the IRS issued a notice basically blessing the PTE taxes as a SALT cap workaround. So what is the PTE tax? It's a pass-through entity tax, and it's a state tax calculated and paid at the entity level. So instead of passing through the income and having the shareholders or partners pay it in an S corp or partnership, they said you can pay it at the entity level, kind of like a C corp. Currently, there's 36 states that have a form of this. So again, just like Wayfair, everybody really jumped on board with this really quickly. And it's not surprising why, since it is just a benefit for the states it's really only a federal impact, so the states don't have a negative impact to enact these generally. Pennsylvania does not yet have a pass-through entity tax, but they do have legislation in place. So that's something we might see going forward and look at like who it would be applicable to, and we'll look at the different things to consider. Most are elective. Connecticut was the only state that was mandatory PTE tax, so this is something you elect into. However, Connecticut actually just changed that, and they will not be mandatory as of starting in 2024. So then there will not be any that are mandatory, they will all be elective. So what you're really looking at is whether or not this is a benefit for you, and that will determine whether or not you should elect into this. As you can see here, these are the states as of June 13th with enacted or proposed PTE taxes. So as you can see, it's most. Pennsylvania is one that's proposed there. All right, and then here are our considerations for what you need to think about when you're looking at PTE taxes. So is it mandatory or elective? As I mentioned, I think Connecticut was the only one, so they'll all be elective, but if it's elective, is it revocable or is it irrevocable? Meaning, can you elect out if you elect in, or are you stuck there once you do it? Is there a deadline to elect? Is it an annual election or just one time? Who's eligible? And what's the rate? Because the PTE tax rate could be higher than your individual bracket. And are there estimated payments? And can you get a credit for taxes paid to other states? A lot of different stuff. Don't have the time to go over all of it today, but again, I'm happy to have that discussion. And then we have a few other considerations as well, mainly aimed around like, if you do this PTE tax, can you still get a credit for taxes paid to other states? Because different states are going to have guidance. I know Pennsylvania has issued some guidance on this about like S corporations versus partnerships, but there's a lot to consider. And then the other thing is, I know some, at least initially, said they would end when the SALT cap is phased out after 2025. So that's kind of another consideration, is that will they still be in existence after this? That I don't know. All right, and then as we come to the end of the webinar, we'll do polling question number 4. So I have another little quiz. I'm sorry, I hope it's not too bad, but give it your best guess. Which state does have a sales tax? Is it Utah, Delaware, New Hampshire, or Alaska? So make sure you answer the polling question. All right, 10 more seconds. Make sure you get your answers in. Oh man, all right, we got a little bit of a mixed bag here. I like that, so because that means I can teach something. So the correct answer would be Utah. So 30% of you got that. New Hampshire actually does not. We call them the nomad states that do not. That's New Hampshire, Oregon. What's the M one? Oh gosh, I'm forgetting myself here. Alaska and Delaware do not as well. Oh gosh, I'll get back to you on that. But Utah does. So we do have a state sales tax in Utah. Okay, and we'll roll into our last topic as we wrap up the webinar. I want to do a few Pennsylvania updates and look at the Pennsylvania budget. Now, the Pennsylvania budget has not yet been passed. We are still waiting on that. So this is a look at the proposed budget, but we'll have to wait and see what actually passes. Again, you have the slides. I'm not going to go over all of these points since we're short on time, but it looks like the one I wanted to touch on is just the decrease in corporate net income tax, just because that is really a big deal for Pennsylvania. It's been so high for so long, and that decrease will really bring us in line with a lot of other states. Oh, and thank you. I just got a message. Montana was the one I could not think of. Thank you. That is the other state with no sales tax. Thanks for closing the loop on that for me. Okay, the other thing too is the expansion of the property tax and rent rebate program. So that was another thing in the budget. This is a benefit to people that either own or rent a home that have a low income. It allows them to get a credit for either their real estate taxes paid or from their rent paid, just to help out Pennsylvania taxpayers. So this is something that it's looking at being expanded. As you can see there, it increases income caps, so more people are eligible, and it also increases the maximum rebate that people can get. So something really beneficial if it passes. The other thing to mention is just Pennsylvania has continued their expansion of MyPath. This is Pennsylvania's online system that helps taxpayers. They can go on and do different tax functions. It's definitely gotten a lot better over the years, and it's used for a lot more taxes now. So just something, it can be a really easy way to either handle a notice or to even file some taxes. I think if you file sales tax, you're probably already on this, but just a lot of different updates to that. If you look at Pennsylvania's website, they have a lot of updates as well. And then finally, I think I'm at the last two slides here, just in time. This is just like the corporate income tax rates. As you can see, Pennsylvania was one of the really high ones with 9.99%, but now we will be reducing that. And then finally, this is just the individual income tax. Pennsylvania does have a relatively low income tax for individuals, so we kind of are on the better side of that. So with that, as you can see, my information is on your screen with my email if you want to reach out with any questions. But at this point, I will submit any last minute questions, and I'll see if I can answer one or two here. If nobody has any, we'll wrap up, but again, feel free to reach out. I know it gets hard with this topic because questions are generally so specific. So again, just feel free to reach out and, you know, let me know. Okay, well, it is 2:59. I think with that, we will wrap things up. Thank you so much for joining us today. Let me see here. So if you have any further questions, reach out. A recording of today's presentation will be posted on our website and social media sites in a few days. And for those of you who requested CPE and answered the polling questions, those certificates will be sent out within the next 2 weeks. Registration is now open for our upcoming healthcare webinar taking place on July 20th. This session will focus on the opportunities and challenges facing FQHCs today. Please visit our website to learn more. Thanks again for joining us, and everyone, please enjoy the rest of your day.